Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken. Today is August 5th, 2023. Our model portfolio is up 7.96% year to date. Our portfolio is currently 100% in cash. And the goal here of SPY Trader Now is to beat the buy and hold investor for the S&P 500. They are currently up 16.69%, so we are not accomplishing our goal, but now our goal is to beat them before the end of the year. So that is what we are trying to do here at SPY Trader Now. So stay tuned and watch us do that. Here are some past returns over the last 3 years for the model portfolio. Last week, the S&P 500 for the week lost 2.21%. We'll go through the charts in much greater detail later on in the presentation. Here are the trades that we made last week. We actually didn't make a trade. What we did was we had a trade on the books called a covered call. We had 200 shares of SPY, and we had a call option which had an expiration date of August 4th with a strike of 417. We let that particular option get exercised. This is what it looks like from the broker when you allow that to happen. By exercising the option for the option buyer, they ended up taking our shares at $417 per share, as agreed upon by the strike price that we had for our position. This is what the position looked like. And you can see here on 8/4/23 is when we closed out 2 trades. So we did have a position in the shares of SPY. I call it stock here because it's shares of the ETF. It's actually an ETF, electronically traded fund. And we purchased it for $428 and we sold it for $417, and it looks like we took a loss of $2,300. But what happened is when we purchased that stock, we did an in-the-money covered call. So we got paid on the option. And when we allowed that option to close off the books yesterday, we got paid a premium for that particular option of $7,322. So all in all, for calendar year 2023, this is how much our model portfolio is currently up. We start the year off at $100,000 and we try to build from there. Currently, on August 5th, 2023, our model portfolio is up $107,961 or 7.96% year to date. If you want to see how I do this throughout the years, just go ahead and hit that subscribe button, ring that bell, and smash that like button down for me. Thank you. If you want to get your own spreadsheet like the way I track mine here, you can go ahead and head over to spytradernow.com and you can download my spreadsheet as a template for yourself for free. Also, if you want to see all of my real-time trade alerts going back for the last 3 years. Here is the equity curve for the model portfolio for calendar year 2023. Here is the equity curve for the S&P 500 buy and hold investor for calendar year 2023. And here are the 2 equity curves combined with a percentage chart so we can compare, because we always compare our model portfolio against the benchmark of the S&P 500. They had a terrible week last week, losing 2% of the portfolio. Because we had an in-the-money covered call, that's why our portfolio did not lose value during last week's action. There has been no movement for interest rates last week. Here's Jerome Powell. The last interest rate hike was done on July 26, 25 basis points, and this is your federal funds rate currently right now. The next announcement will be on September 20th. And will we have a 25 basis point rate hike? I don't think so. I think the Fed's going to skip, but we will wait to see what Jerome Powell does on that announcement. That's next month. Now we are looking at things from the presidential election cycle theory, which states depending upon what year of the election you are in for the president, you have historical rates of return. Currently, President Biden is in his third year of his cycle. The historical average for the third year of the presidential cycle is in positive 16%. Currently, the market is at positive 16.69% year to date. So we are currently at that historical norm average. Now we are looking at things from the bond market. And the bond market is somebody we want to listen to because it is 4 times the size of the stock market. The bond market is telling us to not be invested currently in the stock market because we have an inverted yield curve with rising interest rates. We are monitoring this closely to see how it plays out. The Jerome Powell, what he's trying to do is he's trying to get inflation under control and at the same point in time not kill the economy. He wants what's called a soft landing. So far he has produced a soft landing because the market hasn't had a terrible correction, nothing at all really, 2-3%. I mean, very minimal. So we have to wait and see how this all plays out. By the time this inverted yield curve gets corrected, we do need to correct this. We cannot stay in an inverted yield curve forever. Now we are looking at things from a valuation standpoint according to CMV. And here's the link here, and all the links for everything that I'm showing you will be in the description down below. So if you want to explore any of this product, you can do it on your own with the links that I've provided for you. From a valuation standpoint, we are overvalued, and we are overvalued 55.7% above the modern average market area PE ratio of 20.2. The PE ratio is currently 31.4. On a standard deviation chart, that takes you to 1.4 standard deviations. There is certainly risk in this market. Now we are looking at things from CNN Business Fear and Greed Index. Here is our friend Warren Buffett. Last week we were in extreme greed. This week, currently, we are at greed. So as this comes down, then we can have a little bit, we can feel a little bit easier putting on long positions. When we're over here in extreme greed, that is when you want to be starting to think about taking profit off the table like we did, and to allow us to go to more of a cash position, which we have already done. Now we are looking at things from a seasonality outlook. And this is a seasonality chart for the S&P 500 going back 20 years. Currently we are in the month of August. This is the summer doldrums, August, September, and October. These are very weak months, historically speaking. For the month of August, the S&P 500 is currently down 2.4%. Mind you, it's only been trading in the month for a few days. But historically, there is a 60% probability, which is not great odds. It is not bad odds, but it's also not great odds compared to the other months, that we are going to close higher than when we opened. Now we are looking at things from a long term. This is a monthly chart of the S&P 500 going back 20 years of data. Long-term bull run, correction since 2022, broke out above that. Now I knew that this line here was unsustainable. That has cracked so far. We just don't know exactly how far and how long this thing is going to exactly come down. But I knew that this trajectory was an unsustainable trajectory. The MACD has a positive crossover, but you can see in the chart clearly how it is beginning to flatten out, possibly come back down. Unknown at this time. Slow stochastics is above its signal line and above 80. This is all bullish. From a long-term standpoint, we are so far it looks like we are entering a bull market. Now we're looking at things from an intermediate term outlook. This is a weekly chart. This is candlesticks going back 5 years. And you can see the high that we made here in April of 2022. We broke out above it, but now as of last week, we just closed below it with that big red candle. You can see it right there in the thumbnail. So now we were in this trading range, now we are in this trading range just below it. Certainly not a terrible thing. We are just watching this to see how it's going to play out. MACD has clearly topped and is starting to travel towards its signal line from an elevated position of 15. Now we are looking at a daily 6-month chart. You can see the candlesticks much more clearly. I've put in here a Fibonacci retracement so that we can see where we can have some expected pullbacks. Now normally you pull back to the 38 or the 61 or the 50%. I was hoping to close out of my call option when we hit the 50%, but I ended up letting that get called out on us on Friday to put us in a cash position, because now we can do whatever we want to do. And I'll show you the options later on in the presentation. Now, one good thing that you're seeing in this chart right here is the slow stochastics. Well, first of all, let's establish this. This is bullish. The chart in general is going up and going up strong. This is a pullback. The question is, how much and how long of a pullback are we going to get? And not all pullbacks are pretty. Sometimes they come down, they go up, they come down, they go up, or they come up, they come down, and they continue to go down. At this, where we are at right now, it's a little bit of an unknown. So we appear to be holding this level of support, which almost lines up with this high right here, 445, right in that neighborhood. We may soften up a little bit, then bounce, come back and give us a double top. It's a little bit unknown right now. So I'm going to show you my strategy later on in the presentation, how I want to play this market right now. But the slow stochastics is now below 20. When that slow stochastics, when this market bounces and begins to come up, and this slow stochastics goes above its signal line, that will be a bullish indication for me to take on more leverage in a bull market from a valuation standpoint. This is a ratio chart. RSP, which is the equal weighted S&P 500 compared to SPY, the normally weighted S&P 500. You see three charts in the same chart. Three graphs in the same chart. RSP is the black and the red. RSP, the equally weighted, is in green, and the blue is SPY, the normally weighted. Currently, you can see where the normally weighted and the equal weighted are equal. And the ratio chart, because these are equal, is starting to move sideways. Now, this chart is going back 20 years. There's a lot of history here. And in 20 years, the MACD has only come down below this line here twice. Three times as of right now, and 2 times in the past. And it has crossed above its signal line, which is this dotted line here, the horizontal line here and here, 3 times. And each time it's done that, shortly afterwards is when you begin a nice bull run. Nice bull run. Now the question is, are we in a nice bull run? So we are monitoring this chart to see how this is going to play out. And hopefully we are going to have this nice bull run. And if we are going to take on some leverage by putting on some long call options, and we will profit handsomely as a result of that. Now we are looking at things from the VIX Volatility Index, or the Fear Index. We were in this trading range. We dropped down below it to an ultra low trading range. Now we've popped up back into this area of trading here for the VIX. And you noticed when we popped up, the S&P 500 came down because these work inversely to one another. This black line here is the S&P 500. So now we are watching this right now. I get the impression by looking at the VIX and looking at the MACD and the slow stow that this is going to come back up to the top of this trading range before bouncing and coming down, meaning that we've got a little bit more downside to go on the S&P 500 before we bounce back up. Now we are on the Think or Swim platform, 1-year chart, S&P 500, and we have standard deviations This is the +2 and -2 in gold, +1, -1 in pink. The halfway point is this dashed green line. Now on the 1-year chart, for the standard deviations, currently the S&P 500 is at positive 0.7%. So we came down, just kissed above the +1, and now we have bounced, and now we are heading down on this chart. Now we are looking at the same chart, but instead of going 1 year, we're only going back 6 months. And on this chart, we're at about the halfway point. So we are at the minus 0.2 standard deviation because it's just below the halfway point. Now we are looking at the same chart, except now we are only going back 3 months worth of data. And on this chart, we are at negative 0.8 standard deviations. Now remember, the pink is the -1. In the last 3 months, we have not hit the -1 standard deviation ever. And now we are very, very close to it. So this could be a bouncing point for the S&P 500. We are watching that. But right now, it looks like it's coming down. We just don't know exactly how far. I have just given you a ton of information in this video. Now comes the critical thinking. What are we going to do with that information? Well, as of August 5th, 2023, market summation, according to me, Spy Trader Now, I am your host. My name is Ken. We let the in the money covered call roll off the books, as I told you earlier in the presentation. We are currently now 100% in cash, so we can do whatever we want. So what are our options? We have plenty of options, but let's say we have these 4 options. We could stay in cash. We could do another in the money covered call, and this would be the exact call that I would want to take, which is an expiration date of 8/11/23, only going out 1 week. With a 4:30 strike, the current premium on that trade is $17.69. And that will return for us if we allow that, and as long as trading on Friday, 8/11/23 is above $430 a share for the S&P, then for SPY exactly, then we will have a annualized return on investment of 12.48%. Not bad, not great, but certainly not bad. We are making money. In addition to that, by the way, I get this information by putting it into my covered call calculator. If you want a covered call calculator or a cash secured put calculator, I have it all in my Excel spreadsheet. You can head over to spytradernow.com. Link is down below. You can download this spreadsheet for free. So when you look at my covered call calculator, here is the current trading price for SPY, 446.81. The premium, 17.69, strike 430. I would do 200 shares, which is 2 contracts. I'll put that trade in on Monday. No, I put the wrong date there. Actually, that would be 8/7/23. So it wouldn't quite be a 6-day trade. It'd be a 4-day trade because I'd put it on Monday and roll it out on Friday. And then on Friday, I could have the option of either rolling out that covered call, or I would do, or just let it get exercised if indeed we are trading above $430. If we are not trading above $430, what I would do is just let the option expire and hold my shares of SPY and just pocket that premium that we just captured. All right, so anyways, let's get back into this. So we're only going to make, we're not going to make too much money on this particular trade. We have a break-even cost of $429. So the market would have to drop pretty good for us to actually lose money on this trade. We have downside protection of 3.8% from our current trading of 446 down to 430. And here is your annualized return. That's where I got the 12.48%. Now, let's assume we didn't want to do an in-the-money covered call. We want to do a cash secured put. If we did the same thing in a put, then the premium is only 30 cents and we would only get paid $6.37% annualized. So we're making more money on the in-the-money covered call than we would on the cash secured put with the same strike. So I'll take the extra premium on and do the in-the-money covered call. And then the fourth option would be to buy a call or a put. The problem with that is that to me, the market direction is not clear yet for me to go in this direction. So I'm not going to do a call or a put until I have a clearer identity of what the market is actually going to do. And if we just move sideways next week, this will be, again, a very profitable trade for us because when you move sideways, you don't make money if you just own the shares. But by doing the covered call, we're going to get paid some premium, some time premium. So this is the one that I like the best. So if you want to receive my real-time trade alerts, you can also go ahead and head over to spytradernow.com to sign up. If you have not done so already, go ahead and hit that subscribe button, ring that bell to be notified when I post a new video, and go ahead and hit that like button to help me promote this video. I wish you good trading.